Hello, everyone, and welcome to Intermediate Accounting 2, Chapter 21, Accounting Changes, Part 2. In Part 2 of this chapter, we're going to look at error analysis. So let me just go through the topics that we're going to look at today. So we'll just do a recap of the accounting changes, what type of changes there are, and what the accounting treatment is. And then we'll look at error analysis. We're going to look at examples of errors. There's counterbalancing and non-counterbalancing errors. So we'll look at both of them, and then we're going to look at how do you do a retained earnings presentation if there are prior period errors that you need to deal with. So there's three types of accounting changes: change in accounting policy, so going from one accounting policy, acceptable accounting policy, to another acceptable accounting policy; changes in accounting estimate, so based on new information and experience, you change an estimate; and then correction of a prior period error. So the books of that period have now been closed, and you discover in the present that there was an error that dealt with a prior period. And then the accounting methods for each type of change. For accounting policy, you would do retrospective full restatement. That means go back to when the policy first started and then figure out how your retained earnings would have changed if you're always using the change policy. If that's not possible, do retrospective partial restatement, so go back as far as you can. If that's not possible, then prospective treatment, so going forward, make the change. Change in accounting estimate always uses prospective application. Going forward, make that change. Correction of a prior period error, you would use retrospective application with full restatement. So go back to when the error first occurred and figure out how your financial statements would look, how your retained earnings would look if that error never occurred, and then change your retained earnings for the present year. All right, so when looking at error analysis, there could be errors in the statement of financial position, so the balance sheet. There could be classification errors, putting something as accounts payable instead of notes payable. There could be numeric errors, putting something in, accounts payable as 52,000 instead of 25,000. And then for income statement, you could have errors as well. We can have classification errors, so putting something in sales revenue instead of investment income. The difference between having these two classification errors in the balance sheet and income statement is if you put something in a different revenue box that should have been in something else, like sales revenue instead of investment income, you're still going to end up with the same net income. The only problem occurs when you're putting something in revenue when it should be an expense. So otherwise, there wouldn't be a difference in net income. And net income gets rolled over to retained earnings, so you wouldn't really have an issue going forward if you found a mistake like this. But when we're working with the statement of financial position, those amounts get rolled over. So if you put something in accounts payable instead of notes payable, that error gets rolled over to the next year and the next year and the next year. All right, so just looking at some errors. So there's two types of errors: counterbalancing errors, and these are errors that correct themselves in the next period. And then there's non-counterbalancing errors, which errors that take longer than 2 periods to correct themselves. So if you have a counterbalancing error and you find out in the next period that there was this error, it has corrected itself anyways, so you wouldn't have to do a journal entry to correct it. For non-counterbalancing errors, if it takes longer than 2 periods to correct themselves, and you find out, let's say it takes 4 periods to correct itself, and you find out in the 5th period that there was an error, you wouldn't have to do a journal entry to fix it. However, if you find out the error in the period 2, then you would have to fix it. So let's look at some examples of counterbalancing errors. So let's say that there was a failure to record accrued wages. So on December 31st, 2014, accrued wages of 2,000 were not recognized. So they didn't do a journal entry to record accrued wages. So just think about what the journal entry should be for that. If they were supposed to do accrued wages, how would that kind of flow? What would be the journal entry there? They would have done wages expense or salaries expense. So what they should have done in 2014, which they didn't, is they should have debited salaries expense and credited salaries payable for $2,000. So they didn't do this. So they didn't do salaries expense, they didn't do salaries payable. So in this case, what happens at the end of 2014, because they didn't show this expense of 2,000, their net income is too high because they don't have this $2,000 expense, which means their retained earnings is also too high. So when we get to opening 2015, the retained earnings is too high. So to correct this error, we have to bring retained earnings down, and to bring retained earnings down, we have to debit retained earnings. And then if you look at what the other side of things are, you're going to credit salaries and wages payable because they never did this salaries and wages payable entry. So you would credit it to show that, yes, there is salaries and wages payable that they have to pay. If the books were closed in 2015, so if the books were already closed in 2015, you would have recognized the salary expense in 2015 when you had to pay it, right? So when you realize, oh shoot, we have to pay the salaries expense that we forgot to accrue for, you would have debited salaries expense, credited cash. So you would have done this in 2015 anyways, even if you didn't realize that this error occurred. And that means that the error would have corrected itself. By the time you get to 2016, there isn't an error because retained earnings was too high in 2014, too low in 2015. So by the time you get to 2016, it kind of cancels each other out. Next one, failure to record prepaid expenses. So on July 1st, 2014, the company bought a 2-year insurance policy for $3,000. This was fully expensed in 2014. So what is the entry to correct this error in 2015? So let's just look at what they did versus what they should have done. Okay, so what they did, in 2014, what they did was they bought a 2-year insurance policy and fully expensed it. Okay, so they did an insurance expense, debit, cash credit of $3,000. Okay, what they should have done is you shouldn't have expensed this whole amount. You shouldn't have fully expensed this whole amount in 2014. So if it's a 2-year, so 24 months basically, and there was only 6 months that went by, so July, August, September, October, November, December, so 6 out of 24 months. So if it's so what they should have done, if you do that calculation, they should have only expensed $750 in 2014. So what they should have done in 2014 is they should have done insurance expense. So this is at the end of 2014. So they should have only expensed $750 of it, but they paid for the whole thing. So they would have had a prepaid insurance. So you would just take your 750 minus 3,000 to figure out how much they have left for the other years. So 2250, and they would have credited cash 3,000. Okay, so this is what they did. This is what they should have done. So then what's wrong here? Right, so this means that we've taken too much insurance expense. We took insurance expense of 3,000 when we should have taken insurance expense of 750. So our net income, too much expense means our net income is too low by the difference, so to 2250. And that means our retained earnings is too low by the same amount. So we're going to have to credit our retained earnings to bring it back up. And also this prepaid insurance we never recorded, so we would have to record that too in 2015. Okay, so debit prepaid insurance, 2250, credit retained earnings, 2250. If this error was found out in 2017, for example, so it's a 2-year policy, so it ends, sorry, let's say 2016, so it ends July 1st, or June 30th, 2016. If this was found at the end of 2016, when the books were closed, by that time the $3,000 should have been expensed, right? So it's a 2-year policy. Like by the time we get to the end of 2016, the $3,000 should have fully been expensed. That means retained earnings would have been correct anyways. Okay? So, but because we found this out in 2015, we'd have to make that change. But if we found out in 2016, after the books had been closed, then we wouldn't have an error to have to correct because retained earnings would have been right. All right, let's look at another example. A failure to record unearned revenue. So on December 31st, 2014, the company received $5,000 as a prepayment for a service contract that was going to be completed in 2015. The company included this in revenue in 2014. Okay, so what should they have done? So writing out the journal entry does help you understand what should have been done. So what they did was they debited cash and credited revenue. Okay, so they debited cash, credited revenue, 5,000 in 2014. So this is 2014. What they should have done was actually credited unearned revenue, right? So they should have credited unearned revenue, not revenue. So if they credited revenue, that means their net income is too high, and the retained earnings in 2015 is too high. So we have to debit that. Okay, so we're going to debit it. Sorry, we have to debit that. Yes. Sorry. So we have to debit that retained earnings to bring it down. And 2015 is when we were supposed to record the revenue. So we can record the revenue in 2015. If we were in 2016 right now, we wouldn't have an error because by the time we get to 2016, the $5,000 would have been, like, the $5,000 should have been revenue for 2015, not for 2014. But by the time we get to 2016, our retained earnings is correct because that revenue was recorded. So that would be a counterbalancing error. It would fix itself for the time we get to 2016. So let's look at an example of a non-counterbalancing error. So an error that takes a few more years to fix itself. So the company bought equipment in 2012 for $15,000. This equipment was expensed in 2012 instead of being amortized straight line over 3 years. The error was discovered in 2015. So what's the journal entry to fix this in 2015? Again, you kind of want to do a chart and lay out what happened versus what should have happened. Okay, so if you take a look, I do have a chart here. So what was expensed? The $15,000. What should have been expensed was $5,000 each year if it's straight line over 3 years. So we should have put 5,000, 5,000, 5,000. That equals 15. So the question was asking us, what is the journal entry in 2015 to fix this? So you wouldn't need to fix this by the time you get to 2015 because you expense 15,000 by 2015, and you should have expensed 15,000 by 2015. So there would be no entry to fix retained earnings here. What entry you would do is just if you still have this asset would be just to record the asset and record the accumulated depreciation fully depreciated. Okay, so which wouldn't make a difference on the numbers, but just showing the presentation there. If this error was determined in 2014, would that change our answer? Would we have to do an entry there? So in 2014, by the time we got to beginning of 2014, we should have expensed a total of 10,000. but we expensed a total of 15,000. So we expensed too much, which means our retained earnings in opening of 2014 would be too low because we expensed too much. So we need to credit that. And then we can show the equipment, right? So bring in the equipment of 15, accumulated depreciation up until 2014 before doing the 2014 depreciation entry should be 10,000, and retained earnings, we should bring that back up. Okay, so retained earnings should increase by 5,000 because we expensed 15,000 when we should have only expensed 10,000, so it's off by 5,000. So this error took up into like 3 years to balance itself, to cancel each other out. So if you found out the error in 2015, that wouldn't have an effect to your retained earnings. But if you found it out in 2013 or 14, then you would have to change things around. All right, so let's do a question. If you go to your Excel, chapter 21, part 2, so go to chapter 21, part 2, we have this first question here. So what I want you to do is do this question on your own, and then you can watch, so pause the video, do the question on your own, and then you can watch the take up. Okay. All right, so you've been engaged to review the financial statements of Lindsay. In the course of your examination, the work of the bookkeeper, you examined the work of the bookkeeper and you found these irregularities. Year-end wages payable of 4,100 were not recorded because the bookkeeper thought they were immaterial. Accrued vacation pay of 29,400 was not recorded because the bookkeeper thought you never had to do it. And then insurance that covers a 12-month period was purchased on November 1st, charged to insurance expense of $27.60 because the amount of the check is the same every year. So what we need to do is prepare the journal entries, correcting entries, assuming that they use a calendar year year end, and the books for this fiscal year are not closed. All right, so let's deal with the first one. They didn't record any wages payable, so they didn't do the accrual entry. So this is similar to that first counterbalancing example I showed you. What they should have done was debited salaries and wages expense and credited salaries payable. So they didn't do that. So we have to correct it. Okay, so the books have not been closed yet. So it says the books for the fiscal year have not been closed yet. So we can actually fix this right into this year's books instead of, we don't have to go back or anything because the books are still open. So this was an error that happened for the books that you are reviewing. Okay, so since the books are still open, because it's a review engagement. So if the year end is December 31st, maybe they're doing the review engagement February the next year, but the financial statements have not been finalized because they're not going to be until the review is done. All right, so we can debit salaries and wages expense, credit wages payable. If the books were already closed and now we're in the next year, then we would have to do the same thing that we would have done in our, if you remember the PowerPoint slide, where we would have to record the retained earnings, right? So debit retained earnings and credit salaries and wages payable. Number 2, accrued vacation pay, 29,400 was never recorded. So it's basically the same thing. So you would do, either vacation expense or salaries and wages expense, and credit wages payable, 29,400. And the last one there, insurance that covers a 12-month period was purchased November 1st, charged to insurance expense. So it covers a 12-month period. They purchased it November 1st. They expensed the whole amount, but we shouldn't have done this, right? So how much should we have expensed is what you would have to figure out, and then you'd have to get rid of how much they did expense. Okay. So we can just quickly write down what it is here, how much it was supposed to be. So we expensed the full $27.60, but it was purchased November 1st, so there's only been 2 months, so times 2/12. Yes, to figure out how much should you have expensed. So 27.60 times 2/12. Could probably do this on the Excel. So 460 is what should have been expensed, but the total 27.60 was expensed. So 27.60 minus 460 is what you have to take out of insurance expense. Okay, so you'd have to take out the 2,300. So you would take out 2,300 from insurance expense and then have a prepaid insurance. So this needs to go up here. And then you would set up a prepaid insurance because you never set that up in the first place. Okay, so all you did was debit insurance expense, credit cash. All right, so I hope that makes sense. And let's go back to the PowerPoint. All right, another thing I want to show you is doing a retained earnings statement if you have a prior year error. Okay. Because when you're doing the financial statements, you have to show a current year and you have to show a comparative year, right? So you have to show both years. If there was an error in your comparative year, how do you present that on your financial statements when you know about this error? Okay, so you can't just leave the error there and say, and not like comment on it or like not show that, wait a minute, there was an error here and we fixed it. Okay. So you're going to start off with your beginning retained earnings. If you had an error in your comparative year, then the beginning retained earnings is wrong. Right. So there's a few steps that you want to that you should follow for this to get this correct. Okay, so step number 1, what you want to do is any errors before the comparative year. So if you had any errors before the comparative year, you want to fix them. So fix in your opening retained earnings of the comparative year. Comparative year. Okay, so that means that if you had, so let's say our current year, let's say our current year is 2020 and our comparative year is 2019. If there were any errors before 2019, like for example for 2018, then your opening retained earnings would be wrong because there'd be an error from 2018. So you would have to show this error correction and show that, hey, there was an error, so this could be a 2018 error. Maybe you also had a 2017 error, and then show the adjusted beginning retained earnings. Okay, so this one's wrong. This is why, because we had these errors, and this is the correct amount, or adjusted one. So that's the first thing, or the first step that you want to go through. The second step you want to go through is, so number 2, so any errors in the comparative year, you want to fix in your net income of the comparative year, because your net income is going to be wrong. So if your net income is wrong, then if you have any errors in your net income of the comparative year, you're going to fix it right in your net income amount. So this net income amount has to fix any errors from 2019, for example. Okay, so you would put the correct net income. And then retained earnings gets, dividends get deducted from retained earnings, so you would do that as well. And then you would have your ending retained earnings. So this ending retained earnings isn't going to be the same as opening retained earnings up here, right? Because you've changed things around. So you're going to have a beginning retained earnings for 2020. That's going to be wrong. You're going to show all your errors. So any errors before the current year, all in here, and then adjust your beginning retained earnings. Your net income should be correct because if the books are still open, you can still fix your net income for any errors in 2020. So when you do the adjusted retained earnings, then you should have it the same as what you had last year. All right, so let me just write that next step out. Okay, so step number 3. So all errors before the current year get fixed in opening retained earnings of the current year. Okay, so all your errors, just bring that over here since you can't really see it. So all your errors of 2018, 2017, 2019 errors that you had in your comparative year, they will all get reported right here in this error, in this error correction, this error correction area. So this would be your, in this case, your 2017, 2018, and 2019 error would show up here. And then you would adjust your beginning retained earnings, and now it should match your ending for your comparative year. Okay, so that might sound a bit confusing. So let's do an example here. So in 2016, management discovered that depreciation expense for 2014 and 2015 were overstated by $40,000 each year. Okay, so what they did was they took on too much depreciation. So if they took too much depreciation in both 2014 and 2015, so 2014 and in 2015, they took too much depreciation expense of 40,000. So total error is 80,000. So that means their net income, if they overstated depreciation expense, that means their net income is too low by 40,000 each year. And that also means their retained earnings is too low. So to bring up retained earnings, we would have to credit it to bring it up, right? So retained earnings is too low. We have some additional information. We have beginning retained earnings. So this beginning retained earnings is wrong because it has both the 2014 and 2015 error in it. This 2015 retained earnings is wrong because it has the 2014 error included in it. Net income includes 2015 error, but 2016 net income is correct. So this 145 includes that error of 40,000 in 2015. And then we have some dividends declared. Right, so the journal entry to fix this, if these two amounts are too high, if depreciation expense was too high, that means accumulated depreciation is also too high. So we would bring down accumulated depreciation by debiting it, 80,000. So this is in 2016. So in 2016, if that's when we figured out this error, we would debit accumulated depreciation, and we would credit revenue to bring up revenue back to what it's supposed to be, 80,000. So how do we show this on the statement of retained earnings? So how would we show this on the retained earnings statement if we have errors? So let me show you how that's done. Okay, so your beginning retained earnings is as reported, right? So this 265 and this 180 is what it was reported, but we know there's errors in here. So step number 1, any errors before the comparative year, so in this case, 2014 errors, right? So step number 1, any errors before the comparative year, in this case, the comparative year is 2015. So any errors in 2014 get corrected in the net income, in the retained earnings, opening retained earnings of 2015. Okay, so you want to correct this beginning retained earnings, say it's actually not 180 because there was an overstatement of an expense. So your opening retained earnings should have been 220 for 2015. And then step number 2 is any errors in 2015 get corrected in your net income of 2015. So if you go back over to the next slide, the net income for 2015 was reported as 145, but we know that's wrong because that includes the overstatement of depreciation expense. So we're just going to add back the depreciation expense and have the correct net income. Then you're going to subtract the dividends, and your ending retained earnings for 2015 is 345. Now we get to 2016. We know opening retained earnings is incorrect, so we're going to correct it for our 2014 error and for our 2015 error. So this is step number 3. So both errors you're going to use to correct it. Now our adjusted beginning retained earnings matches what our ending retained earnings is for the previous year. Okay, so that now matches. Our net income is correct for 2016, 125. Dividends of 80, and our ending retained earnings is now 390. Okay, so this is the retained earnings statement presentation. So if you just remember the steps, step number 1, any errors before the comparative year get corrected in your opening retained earnings of the comparative year. Any errors in the comparative year get corrected in your net income of the comparative year, and the total of all your errors from step 1 and step 2 get corrected in the opening retained earnings of the current year. All right, so let's try one more question for error analysis, and I'll show you the retained earnings statement presentation. All right, so we have a bunch of errors that happened. It says that the financial statements contained the following error. So ending inventory says positive was overstated, negative was understated. So ending inventory was overstated by 9,600 in 2013 and understated by 8,100 in 2014. Depreciation was overstated by 2,300 in 2013. An insurance premium of 66,000 covering the 3 years, 2013, 14, and 15, but the entire amount was charged to expense in that year. So it was charged, so the entire insurance premium was charged in 2013 when it was related to 3 years. In 2014, fully depreciation machinery was sold for $15,000 cash, but the entry was not recorded until 2015. Okay, so they recorded some machinery in 2014, but they didn't record the sale entry until 2015. Okay, so what I want you to do is calculate the total effect of these errors on 2014 net income, calculate the total effect on Nelson's working capital at the end of 2014. If you remember working capital, it's your current assets minus your current liabilities. That's your working capital. Calculate the total effect of errors on your retained earnings in 2014. And then seeing this information, prepare a revised statement of retained earnings for 2013 and 14. Okay, basically 2014 is going to be your current year, 2013 is going to be your comparative year. So what I'd like you to do now is pause this video, try going through this question, and then you can unpause it to look at the solution. So let's take this up. So first thing is, what is the effect of all these errors on the 2014 net income? So the first error, the overstatement of 2013 closing inventory error, how does that affect 2014's net income? So an overstatement of ending inventory in 2013 means if ending inventory is too high in 2013, if ending inventory is too high, that's going to make your net income in 2014 too low. In order to explain this, let's go back to what the formula is when you're figuring out inventory. So if you remember the formula, so beginning inventory plus purchases minus your ending inventory gives you your cost of goods sold. If your ending inventory from 2013 is too high, that's going to make your beginning inventory too high. So let's say, let me just put numbers. Let's ignore purchases for now. But let's say your beginning inventory was supposed to be 4, ending inventory was supposed to be 2. That would make cost of goods sold 2. If your beginning inventory is too high, so if it's 5, 5 minus, and everything else stays the same, 5 minus 2, that means your cost of goods sold is also too high. If your cost of goods sold is too high, then your net income is going to be too low because you have too much cost of goods sold. Okay, so that's how we get the understatement here. The next one, so we had understatement of 2014 closing inventory of 8,100. So let's try this again with the formula. So I'll just do it back over here. Equals cost of goods sold. So let's say what happens when your ending inventory is too high. Okay, so let's say this is 5. So let's say this is what it should have been, minus 2. Okay, so let's just say, so let's say it's your beginning inventory is correct, it's supposed to be 5, your ending inventory is supposed to be 2, your cost of goods sold is 3. If your ending inventory is too low, so we have an understatement of ending inventory of 8,100 in 2014. So if your ending inventory is too low, that means your cost of goods sold is too high. If your cost of goods sold is too high, that means your net income is too low. So again, understatement of net income for this 8,100. Okay. So if it's kind of confusing, what happens if inventory is overstated or understated in a year, then you can go back to just a simple formula for beginning inventory plus purchases minus ending inventory equals your cost of goods sold, and kind of play around with that, and that's how you realize that these two are understated. All right, next, the 2013 depreciation error. If we have an error of depreciation expense in 2013, that's not going to affect our 2014 net income, right? If we have an error in depreciation expense in 2013, that's going to affect 2014 retained earnings, but it's not going to affect 2014 net income. Because it seems like we didn't have an error in 2014 depreciation, so we did the 2014 depreciation correctly. So no impact there. The 3-year insurance policy that was totally expensed in 2013. Again, what I like to do is what happened versus what should have happened. Okay, so we had an insurance policy that should have covered 2013, 2014, 2015. So what was expensed versus what should have been expensed. Okay. So what they did was in 2013 they expensed the full 66,000, and then 2014, 2015 they didn't expense anything. What they should have done is taken this 66,000 and expense it over the 3 years. Sorry. So what they should have done was expense this over the 3 years. So what happens here if you kind of just look at the differences between those. Okay, so the difference is in 2013 we expensed $44,000 too much. In 2014 we should have expensed 22,000. 2015 we should have expensed 22,000. So if we're just looking at 2014's net income, 2014's net income is overstated by 22,000 because we should have recorded an expense, but we didn't. So our net income's too high. And then the last one, sale of that fully depreciated machinery in 2014. So think about what was the journal entry that was done here. So what we would have done, so it was fully depreciated machinery. So that means your machinery account in your accumulated depreciation account was the same amount. Okay, so we don't have to factor that in here. So you would have sold it for $15,000 cash, and you would have ended up recording a gain for 15,000. Okay, so debit cash and credit your gain for 15,000. So that's what they did. They did this entry in 2015 when they should have done it in 2014 because that's when they sold the machinery. So if this should have been done in 2014, then you should have had a gain recorded in 2014, which you haven't. So your net income is also understated by 15,000 in 2014. And then the total impact to net income, if you total all these up, is 10,700 understatement. The next question is asking, what is the effect of the errors for 2014 working capital? An overstatement of 2013 closing inventory would impact 2014 opening inventory, but then when they would have counted the inventory in closing, they would have fixed that, or they would have adjusted the ending inventory for whatever the count was. Okay? So there wouldn't be an impact here. Having an understatement of closing inventory in 2014 would mean that if you underreport your inventory in 2014, that means your inventory account would be too low by 8,100. So working capital only affects your current assets and current liabilities. The 2013 depreciation error wouldn't have any impact to 2014 working capital because it's not a current asset, it's a long-term asset, right? The 3-year insurance policy totally expensed in 2013. What the journal entry that should have happened, if we look at this, so the journal entry that happened was they did insurance expense debit, and they credited, and then they credited cash for the total of 66,000. What they should have done was debit insurance expense for the 22,000. They should have debited prepaid insurance and then credited cash. So they should have debited prepaid insurance for the 44,000 for the 2014 and 2015, and then they should have recorded the total cash of 66,000. Okay, so that's what they should have done. So prepaid insurance is a current asset, so your current assets are too low because you never recorded 44,000 there. So too low. Oh, sorry, by the time you get to the end of 2014, sorry, we're in 2014. I did the journal entry for 2013. So by 2014, so this is what was supposed to happen. So this is what happened in 2013. This is what should have happened in 2013. And then in 2014, what should have happened was you should have debited insurance expense, the 22,000, and credited prepaid insurance. Okay, and then credited prepaid insurance, 22,000. So if your balance of prepaid insurance should have been 44,000 at 2013, and you credited 22,000 in 2014, then your balance should now be 22,000 in your prepaid insurance as of end of 2014. So your prepaid insurance is too low because you never recorded an entry for prepaid insurance at all. Sale of fully depreciated machinery of 15,000. So let's go back to that journal entry. Okay, so you never recorded this journal entry in 2014 when you should have. That means your cash account is too low. Yeah, so your current asset cash account is too low by 15,000. All right, so those are your impacts to working capital. Part C says, what is the total effect of your errors in the retained earnings? Okay, so what is the retained earnings effect at the end of 2014? Your overstatement of closing inventory is not going to have an effect on your retained earnings because it's a counterbalancing error. So the error would have fixed itself by the time we get to end of 2014. Having an understatement of closing inventory would understate your your retained earnings. So if here we said it would understate our net income. If something's going to understate our net income in 2014, then it's going to understate our retained earnings in 2014, right? Because net income goes into retained earnings at the end of the year. The depreciation error, for the depreciation error, we have in 2013, our depreciation expense. So here, our depreciation expense was too high, which led to, if our expense was too high, our net income was too low, which means our retained earnings opening 2014 is too low. Okay. The 3-year insurance policy, that was fully expensed. So if we go back over here, we fully expensed 66,000, but by the time we get to end of 2014, we should have expensed 44,000. So we're off by 22,000. Okay, so if we expense too much, that means our net income for 2013 was too high, which goes into opening retained earnings of 2014. So it's too high by 22. Sorry, our expense is too high, which means our net income is too low. Our retained earnings is too low by 22,000. And then the last one, the fully depreciated machinery, it understated our net income for 2014, so it would understate our retained earnings for 2014 as well. All right, so the last question is prepare a revised statement of retained earnings based on this information. So we got our opening retained earnings, our net income, our dividends. So these net income numbers include the errors in 2013 and 2014. Okay, so we start off with our opening balance. So our opening retained earnings, as reported, we have to show. Okay, so that's where those numbers are coming from. Then, so we have our current year and a comparative year. Okay, any errors, so step number 1, any errors before the comparative year are fixed in the opening retained earnings of the comparative year. Okay. So we don't have any errors before 2013 here. So we don't have to do step number 1. We're going to assume that 1.25 million of opening retained earnings in 2013 is correct because it doesn't say anything about any errors before 2013. So we can bring that number down. Our net income, we know it says our net income for 2013 is 422. So any errors in the comparative year get fixed in the net income of the comparative year. So any errors in 2013 will have to get fixed in our net income in 2013. So I've already done the calculation here. So let's see what actually we can go back up there. Okay, so we're dealing with 2013. So 2013, our ending inventory was too high. So if our ending inventory is too high, we can do that little formula again. Okay, so beginning inventory plus purchases minus ending inventory gives us our cost of goods sold. So if this is what it should be, okay, if our ending inventory is too high, so it's 3, that means our cost of goods sold is too low. If our cost of goods sold is too low, our net income is too high. So we have to bring down our net income by 96,000. Okay. So our net income is too high by 96,000, so we have to subtract that from the net income that was reported. And then our depreciation expense was too high in 2013, so that's going to make net income too low, which means we have to bring up net income by 2,300. Okay. And then this 66,000 was an issue too. We recorded an expense of 66,000 in 2013. So if we just go down to our chart, when we should have only expensed 22,000, so our net income is too low by 44,000, so we have to bring that back up. Okay, so we're subtracting the 96,000, we're adding the 2,300 for depreciation, we're adding the 44,000 for our insurance. So if we do all that, we will get 458,700. And then we'll subtract the dividends declared, which are shown up here, 65,000, and we get our ending retained earnings amount in 2013. And then the total of all the errors get corrected in your 2014 opening retained earnings, right? So all the prior period errors get corrected. So the 3 errors we had in 2013, we just went through. We would take that and adjust our opening retained earnings. So now our opening retained earnings matches our ending retained earnings from the previous year, right? So you want to double check, always double check that that works out, because then you know that you did it right. And then our net income for 2014 needs to be corrected. So it says that we had a net income of 375. We know that's wrong because if you go back over here to our first question, we know that our net income is understated by 10,700. So we'll add 10,700 to our 375, and that gives us 385,700 minus our dividends declared at 45,000, and we get our retained earnings of 1.1984,400 for 2014. All right, I hope that makes sense. Thank you for listening. Take care.